Good afternoon. You're watching Tracking Trends with me, Nikunj Dalmia. What are the trends? Well, when the market itself in a bull market, it's not a big struggle to find the trends. But within the bull markets, where is opportunity? Where is risk? Like they always say, in a bull market, you should never get blinded to risk. In a bear market, you should never get fooled by a value. So we'll take that theme forward and we'll be discussing IT today. Brokerages are of the view that 2024 could be a comeback year for IT. In fact, they never fell off the radar if you ask me, because the IT index last year gave handsome returns. But has the tide turned? Has the AI effect which hit the market in 2023, has that been digested by the market? These companies generate so much of cash that one would argue and say that things incrementally could actually improve on the balance sheet front for them. So we'll discuss all that and much more for you, but here's a look at first the market headlines. Indian markets at the highest point of the day. We are coming back. Are we likely to cross over the range? Let's see. But today the market, for a change, is going against global cues and showing a lot of inertia. Broader markets, they continue to outperform. For me, the mark of the correction would be when broader market collapses, which it is not collapsing. And banks, FMCG and real estate stocks are gaining. This is largely domestic in nature, and bucking the trend, well, you've got IT. Coincidence that we are discussing IT. So the big question which we are discussing, I just flagged them off. IT versus bank, what are brokerages looking at? Will IT companies make a comeback, or IT stocks, will they make a comeback? Now, before we do that, it's important for me to establish for our viewers that what has been the 1 year, and the 3-year change for IT stocks. Before we start getting excited about the fact that, okay, IT is all gloom and doom. In last 3 years, Infosys has given a return of 17%. HCL Tech has given a return of 45%. TCS right at the middle there with a 17% return, and Wipro for reasons, but they have not given fantastic returns. So HCL Tech actually has been a racked outperformer. So before we say IT, I think now it's time to start thinking stocks. In the same year when HCL Tech has given a 37% return, Infosys gave you a 1% return. But for me, what really matters when I look at stocks is the rate of change and the underlying price of the business. And this is where I think there is a bit of a yes and no for me. When you're buying something where the sector is not in demand, you essentially should be looking at buying them below their averages. But in case of IT, and there you go, that is the data point here. Let's look at the valuation check here. For IT companies, Infosys is trading just above its 5-year average. TCS is trading at its 5-year average. Wipro is trading above its 5-year average, and HCL Tech is trading at a premium to its 5-year average. So where is the value? The sector has gone through a big churn. The opinion is negative. But IT stocks in last 5 years and IT stocks right now, well, some stocks are trading at a premium. And if IT stocks are trading at a premium, you got to ask yourself is that where is fear in the market? And where is real opportunity in the market? Now, let's look at one more graph and then I'll get Kunal, ready to talk about it. In terms of the P multiple, the 5-year average for large cap IT or the IT index, 26 times, 3-year average 25 times, 12 month is 25 times. So IT, even though you may like to call it contra and brokerages are saying that this could be the year for IT stocks, frankly, IT is not a sector which, at least on historical averages, could be called as cheap. Let's load that graph again. 5-year average for IT companies, I want to repeat this point here, because for those who are thinking that IT stocks are cheap, they're not cheap. A simple benchmark of IT index is the 3-year average. Kunal, is the pen ready?
Correct.
Okay. So Kunal, I'll get into the technicals here. Yep. But for me, when I'm looking at a sector, I look at if a sector opinion is below what the 5-year view is.
Correct.
This is the worst we've seen in 5 years for IT.
Yes.
COVID sugar rush is over. Then valuations actually are in and around the 5-year average.
Correct.
7 chalo hata dete hain.
Correct.
This is the
22.6. Correct. The 3-year average.
So my point is that the sector is not cheap. Sasta nahi hai.
Correct.
And growth is not coming back. Then why are brokerages bullish? Let's look at it. Why are brokerages bullish then? Why are brokerages bullish on IT as a sector when we know that the valuations valuations essentially are not really what could be called as cheap. First, they see signs of growth bottoming out. With IT, when sector comes back, it will give you a surprise on the upside, surprise on the downside. Growth tends to accelerate in H2 FY24. I have not seen evidence of that, frankly. And earnings to support expanded sector multiples. Pivot to cost saving and low base recovery, logical. And resiliency of operating profit margin. So it's a hope trade which is built in here. That you're buying a sector on the assumption that this will go right. AI is behind us. Disruption is not real. And things may not change. Now, I have a slightly differentiated view, Kunal, on IT. Which is that when Y2K happened, everyone thought that the sector would be dead. It made a comeback.
Correct.
When the pivot happened from enterprise to digital, everyone thought that Indian IT companies will not survive.
Correct.
But they made a comeback. So I'm being a big believer in IT. Today, Indian IT exports are $250 billion as much as what Arab Aramco's oil exports.
Correct.
But this time I'm feeling different. I'll tell you why. Because this is a change of allocation and manpower. Number of people who are doing coding 100, now that number will be 80. So the basic model for me actually changes. That's my view. That for the sake of being contra, don't be contra. So let's look at charts, Kunal.
Correct.
The IT index. 1 year, 2 year, 3 year. What do you want to look at?
So we can look at the last 2 years of charts because I think that's where September 2022 is where the IT index had formed a low. That's where Nasdaq and many of the global indices and even the large cap IT stocks had made a low for themselves. There was this 1 year of no action period for the IT index. So even if you look at September 2022, this was around 26,500 for the Nifty IT index. Look at this 1 year of no action for the IT index.
20% for a sector where the opinion was bad, it has managed to beat the Nifty. So there is no bearishness. That's my point.
Yeah, there is no bearishness because I think major part of the correction actually happened in 2022, Nikunj. You know, you had Infosys, TCS, large cap stocks like Wipro, etc. They were back to 30-40% in a matter of just, I think, 8 or 9 months. What they did post that was just to spend time at those levels. So that's what you call as a time-wise consolidation.
Is it over?
It looks like it's over. The worst is behind. Because I clearly remember, I think Infosys specifically, those 2 quarterly results which happened to the stock, and I'm talking about the last 8 to 9 months, the stock did not break that September 2022 low. Even after 2 very bad, and I remember market expectations was extremely negative even at that point of time. The stock survived to break below its major low, and now it's slowly and steadily gradually moving up higher. So I'm not saying that it's sign of strong bullishness or optimism coming by. Maybe the market traders are a lot more watchful this time around for the India IT index, but they're not as bearish as what they were maybe over the last 6 times.
Okay, now let's look at HCL Tech. Now just remember a number 4%. Infosys has given you a return which is in single digit in last 1 year. Now let's look at HCL Tech, and this is where I think the big surprise comes in. So we should stop talking IT. We should talk stocks now.
Yeah.
HCL Tech has given you 53% return.
Correct.
And Infosys has given you a 3-4% return.
Correct. Same as with TCS.
Wipro has not given you great returns. TCS has given reasonable returns. So can I say that really for the charts which you track, HCL Tech is the way forward for 2024?
Well, yes, HCL Tech is the way forward for 2024. Even Wipro, even though the stock has not given great returns, but the recent charts have been very bullish. Nikunj,
let's look at Wipro, please. Yeah.
So even the recent charts have been very bullish. The stock has formed a low at 400. It's almost at 450 levels. Even the last 3-4 days of correction for the stock, it's outperformed many of the other peers, large cap peers like TCS and Infosys.
Okay. Now let's look at what brokerages are saying, and then we'll do our blackboard drawing, handwriting. Roz change kar rahe hain. Yeah, just picked up a pen and trying to scribble handwriting improvement. Never thought that at this stage I'll have to start working on my handwriting. But I guess the demand of the show. This is the verdict from brokerages, Kunal.
Correct.
Positive on Infosys, neutral on TCS, negative on Wipro. Positive on Tech, HCL, L&T Tech, neutral on HCL Tech, and negative on Tech Mahindra. What would you like to take out and add?
So out of this, I would believe HCL Tech should be one of the stronger pick over here.
So technically HCL Tech should be here?
Yes, HCL Tech should be here. Okay. And I think Wipro from being negative should now come back to at least the neutral list, if not the positive.
What should be here?
On the negative side, so there is a mid-cap named Reddington, which has still been bearish.
Largely.
Yeah. So none of the large cap stocks are actually showing any kind of bearishness.
Blank page now. Let's summarize our today's interaction. Pens ready? Okay. So
Yep.
top. ठीक है. Let's zoom in. Top IT. Okay. One.
I'll go with HCL Tech first.
Second.
According to me, it's Wipro.
Any mid cap IT or any other third name?
Birla Soft.
Okay. So this is what Kunal feels technically are the three stocks. What could be the returns here?
So, see, IT is traditionally not a high beta kind of a sector which can give you 30-40% in a year. But I think even if you look at a moderate expectations, it should be at least at 20% for the large cap names, HCL Tech and Wipro, and maybe a 25-30% for Birla Soft.
Okay, so let's just zoom into the screen. While I personally feel that IT is not a steal, it's not cheap. Brokerages feel that this could be the turnaround sector, and Kunal feels that technically these are the three stocks which in a sense could give you great returns. So it's really a blend of editor take, brokerages, and the technical take on a 360-degree view on IT sector. Thank you, Kunal, as
Thank you so
always. And that's how the stack is. Let's take a break, but before that, here are some voices on IT sector, specifically Rajat Rajgadia, we've got Hiren Ved, and also Ravi Dharmeshwar.
Feel over a longer term period, AI is more a productivity enhancement, but in the shorter run, clearly it will create challenges. Y2K was a tailwind. Y2K was not a challenge for the IT sector. But if you remember, during Y2K days, these companies used to grow at 60, 70, almost 100% also. Today now these companies grow at 8, 10. In fact, they struggle to grow at 8, 10%. One, their size has changed. And second, the business has become commoditized, and AI will actually commoditize it even further. So, so there are two things that the IT companies are running at. There is this old legacy business which is rolling off, and then there is this new business which is the digitization, which is picking up. But there is the one that is rolling off faster than the one that is growing. So at an aggregate level, these companies are not able to grow beyond 8-10%. And we have seen some of the stalwarts this year give guidance of 1 to 3%, and then within that 1 to 3% also further narrow it down to towards 1% rather than towards 3%. I think that is splitting hair. The fact of the matter is these companies are now commoditized, matured in nature, and they have not reinvented themselves. So giving a 25-30 multiple to a 8-10% grower in a good cycle, I don't think is a very smart thing. So that does not excite us. There is no re-rating possibility over here. So I would wait for the valuations to become so attractive in this case, where some amount of revival in growth can also lead to re-rating, which is what happened post-COVID, right, in most of the IT companies. But I don't see that today, so that is not something that excites me.
We are still looking at an environment where global growth and the US GDP growth is going to be slowing down in CY24 as compared to CY23. And there could be some revival beyond that in CY25. But at least the next 12 months, appear to be a weaker growth, year. So that's the reason why we continue to stay underweight on IT services. And maybe once we begin to get towards the tail end of the next calendar year, and maybe the market would have factored in, by that time, the demand weakness, etc., it would be a good time to start considering at that point in time. But for now, we are underweight on IT.
All right, let's address our query segment. Sanjiv Bhasin is ready. First query from Ganga Raj from Mangaluru. Thank you for sending us your query. And the query is 6,000 shares Bhasin Saab of Yes Bank at an average price of 16 rupees. Now, everyone is of the view that Yes Bank has not participated. There's a P investor who's come in. Capital is not a problem. The brand has got a new identity. But yet, even if I consider other PSU banks, some of the, AS Bank frankly has been an underperformer given that now there is a P investor who's backing it. Why is that and what should one do?
So Nikunj, you have to firstly understand Yes Bank is now on a very big capital base, almost 40,000 crore. And the infusion of capital has definitely been a trend setter for the bank. And I think Mr. Prashant Kumar has led it from the front. But return on equity will take time. And why underperform? From 12 rupees, it has hit 23. It has almost doubled in the last 1.5 years. And I think that the capital adequacy ratios, the NIM, the net interest, the brand is doing extremely well. But you will have to give it more time. I think if you can sit through this year, then maybe you can see levels of 35, 40. But remember, the enlarged capital base will make it little difficult for return on equity. It is going to be a slow mover, but a sure mover. That is what your outlook should be. So you should look with a 2-year trend. This stock can double from here, maybe by the end of this year.
Now the advantage or a disadvantage which a franchise like Yes Bank is that it's large and it's liquid. And when you got a large and liquid name where the equity in a sense has only increased, you will actually see a lot of volatility. B, there could be a potential overhang of some of the banks of ownership in Yes Bank who could be looking at selling it. So you got to be cognizant of volatility and future supply which could come in, but if the market as well, the future supply would be absorbed. Second question, another bank, RBL, Jatin Shah, 2,500 shares of RBL at 285 rupees. Buy, sell or hold, Bhasin Saab?
Well, hold definitely. RBL is the only bank in the private mid-cap space which has now no more promoter entity. Nobody has more than 1.5 stake except Mahindra, which has invested 4%. And I think this bank has weathered all the negative storms. The present management is doing an extremely good job. Their floated NBFC, which is a co-lending institution, is doing extremely well. They are adding even more branches across the board, and their MSME stroke retail flow is growing very, very strongly. I think their liability franchise also will come out with very stellar numbers. I have not seen the number for this month, but I think you could have a go at 350 on this stock. This has been a volatile stock in the sense, but all declines in this stock are buying opportunity. It is making new highs in the bank nifty, and I think this is poised for 350 over a period of time. It still trades at maybe one-time price to book or lower than that, and I think it's a very good space in the mid-cap banking space.
All right, Bhasin Saab, thank you very much for joining us. Thank you for your thoughts. Now, before we wrap, here are some more thoughts on specific stock ideas from Rajat Rajgadia when we spoke to him earlier in the morning. He says, choose between SBI and ICICI Bank. Mahindra & Mahindra is a long way to go. And small themes like jewelry, QSR, they're evergreen themes for India now.
Just within the Nifty, I would think you can make one pick between an SBI or an ICICI. I think second is M&M as a company looks pretty good for us. When you look at the entire sum of the parts story, you may have a scenario where all the pieces are now beginning to look good for them for the next 2 years, right? So I would think that M&M is again another thing which can look pretty good. I would think that if we are so positive on industrials and capex, then the one allocation stock in this country is just L&T, right? And that will continue to compound because the size of the opportunity they will target every year will keep growing high. I don't know how much market delivers in 2024, and I think it's going to be a rather volatile year, right? Just because of the levels where we are starting, right? But I think the trend is more. And lastly, one thing that we got taught last year, right? India, while top down is very good, the opportunities on the bottom up are fantastic. So safe to say that 15-20% earnings growth is likely, not just this year, and that's what our estimates are also pointing out, right? And when you have aggregates at 15-20%, then you have to find out buckets which grow more than that, because those exciting growth sectors are the one where you typically try to compound your money. I think if we do base case 15% earnings growth, right? And I think that the rate cycle in the global markets end of this calendar year would be lower than where we are starting today. That's again a consensus that you would see getting built on. Assuming no re-rating, at least plus minus 2-3% should be the index return.